All right, so the title of this presentation is Strategy Performance Report, specifically the Trade Analysis tab. I'm not sure if everyone here has used the Strategy Performance Report before, but it's a tool that TradeStation provides in order for you to gauge the strategy's performance and somehow build that confidence that every strategy trader needs in order to trust the strategy rules and let it trade, for you automatically. And so today I decided that we're going to take a look at the trade analysis tab. And here and there we may sprinkle in some information from other tabs, but the trade analysis tab is going to be our focus. We are going to be doing a series of strategy performance report classes. There is a lot of information that we need to digest and try to explain. So just creating one single class on the strategy performance report is doing it a disservice. So I want to create this series so that you have enough information about all the metrics that are in the strategy performance report so that you can use them in your strategy analysis. So let's go ahead and take a look at the disclosures. Just keep in mind that every symbol and idea that we talk about is going to be for educational purposes only. These are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, and that past historical performance is no guarantee of future results. The examples that we're going to show here are just that, examples. I mean, these are not recommendations and they're not going to project performance going forward. I want everybody to be aware of that. So we're going to focus on just the metrics and how you can use them to analyze strategy performance. Let's keep that in mind. For additional information on these disclosures, go to www.tradestation.com/important-information. And Manolo will also share the link to our disclosures right there in the chat in just a moment. Thank you guys for being here. Let's go ahead and get started. I'm going to set up my TradeStation to a strategy backtest because that's the only way that you're going to get the strategy performance report to pull up on your screen. So let's go here to apps and open up a chart analysis. I didn't have a symbol or a strategy planned out. So let's go ahead and see what we can build in just 30 seconds. This is a chart of Apple. I'm going to go to studies and add strategy. We're going to use one of the canned strategies that comes with the TradeStation platform. We have dozens of those strategies. And today, let's focus on the MACD strategy. So we have two of them. One will generate long entries and the other generates short entries. And they're very specifically cleared. I mean, they're very specifically labeled LE and SE for the purpose that they were created for, long entry and short entry. And of course, I want to add them both to the screen or to the chart because I want these two strategies to kind of flip back and forth between each other. So they may be in a long trade and they switch to a short trade. So it's like a strategy that always keeps you in the market, either a long or a short position. So we're going to use the strategy on Apple that sometimes has this very significant trends happening. And of course, the MACD strategy is a trend following strategy. Let me click OK. The strategy goes on the chart. And all you need to do is go to the data menu right here on the top of the chart and go to the strategy performance report. So as quickly as that, we were able to go from 0 all the way to having a strategy on the chart and then having the strategy performance report giving us a full evaluation on the strategy. So let's take this step by step. Let me pull this vertically so we can see all the numbers in it. You're going to see that the strategy performance report has multiple tabs at the bottom. As we said at the beginning of the presentation, we said we were going to focus on this trade analysis tab. Although when you pull the report up the first time, it's going to default to the performance summary. Of course, everybody likes a performance summary because it tells you, how good the strategy is or was, historically, and if there's any sense to even continue looking at the strategy. You can see how the strategy has a net profit of $10,000. This is in a time span of 5 years. You can see the date range right here at the top of the strategy performance report. But I'm going to go a little bit higher than, 5 years. I'm going to load 10 years on my historical backtest on a daily time frame. Loading historical data on TradeStation is very easy, and it just requires you to request that data from the data network. So if I type in 10 years, you're going to see how the command line pulls up right here in the middle of the screen. This is a quick way for you to request more historical data. I'm loading 10 years and hitting enter, and the strategy performance report recalculates, so we went from, $10,000 net profit to $12,000. So that was not a big change considering that we added an extra 5 years of data. So I'm sure there's going to be some periods in the historical backtest when the strategy did not perform well. It was probably a flat line on that equity curve line, but we're gonna get to that and take a look at all the different measures and metrics that we can analyze. I wanted to increase the number of trades here. If you look over here, we have the total number of trades, and we have 165. When we had 5 years of historical data, this number was 80, which is still a good size of trades. Don't get me wrong. Any textbooks that talk about strategy evaluation say that you need at least 20 to 40 trades to have some significant numbers to look at. If you don't have enough trades in a strategy performance report, there may be not sufficient data to actually rely on the results. But once you have enough, a big enough group of trades, you can have a better analysis of those trades. I'm not sure which information you're referring to. Are you able to see my TradeStation platform? Okay, so I see that somebody had commented earlier that they could. You can only see the charts. So okay, you can see both. Okay, so you can see the chart and you can see the strategy performance report here on the left-hand side. Okay, great. So just wanted to make sure that the screen was coming in completely. So okay, so let's continue talking about the strategy performance report and go back here to my PowerPoint, because I wanted to provide you a good PDF that that is a collection of all the different metrics that are available in the strategy performance report. As somebody suggested right here in the chat, you had the ability to click on some of the performance metrics and get some sort of pop-up window or some sort of a dialogue giving you detailed information about that particular metric. Things have changed. It actually caught me by surprise this morning because you don't get a pop-up window anymore. Let me go back here to Trade Decision and show you what I mean by that. If I go to the Trade Analysis, which is a tab that we're gonna focus on today, if I go to the very top and I click on, for example, total number of trades, before I would click here, let me move this away. I would click here and it would give me some sort of a window. Now it opens up the TradeStation help. Now this is just, of course, all the documentation exists in help, and the little pop-up window that would show up before, it was actually feeding from the help. So what I found is that you can click over here on the search field and search for strategy performance report. You search for strategy performance report. This will look for all the documentation on the strategy performance report. And it also tells you the specific tab that it is defining. The one that we're looking at is the trade analysis tab down here, strategy performance report, trade analysis tab. Click on it. And then it gives you all the different metrics that are used in there with clickable links that you can click on to find the details on each one of these metrics. What I've done is that I've compiled all those definitions into the PDF that we are providing here in class. So the link that Manolo shared with everyone here contains all these definitions, and you can use that as a reference. All right. Yes, I agree, Joshua. It was faster the old way because the pop-up window, you could scroll through that window and find what the definition was. Now That has changed. I know the technology that was used on the strategy performance report was enhanced. You may not see it as an enhancement if it broke one of the things that you liked at the best, but it is a little bit more organized when it comes to viewing. Some of the rows and some of the columns are more organized, and it gives you a better view of the report. Okay, so let me go ahead and close out of this, and let's start off with the first definition, which is the total number of trades. Total number of trades, as the name implies, are all the trades that make up our strategy performance report. It says here, of course, that you're looking from 20 to 40 trades in a strategy performance report to have some significant measures. A lot of time you have these wonderful strategy performance reports, and then you go into the total number of trades, and then there's only 10 or 12 trades. That's not a significant number to have confidence that the strategy will do the same thing going forward. The more trades you have and the more consistency you're able to achieve amongst all those trades, the better for building that confidence on the strategy. This is going to add all the winning trades plus the losing trades and give you a total number of trades. On our strategy performance report, which is based on the MACD strategy on 10 years worth of data of Apple, we have 165 trades. 73 of those trades were winners. 92 trades were losers. On a trending strategy, it's very common to see more losers than there are winners. But that's okay, because there is a little fact about those losing trades that the losing trades are usually less in amount than the winning trades. So the winning trades are going to be larger. So it doesn't really matter that you have more losers than you have winners, as long as the net gives you a positive amount. All right. In terms of sizing on this strategy performance report, we have a good foundation, 165 trades. So we're going to leave it at that. I know that it's a long historical back test, 10 years of historical back test. I find to be a lot of historical data. But if you're a long-term trader and are designing a strategy that is a long-term strategy, then it may be the way to go in your particular case. If you're more of a day trader and want to take trades in a shorter time span, then this may not be the type of strategy back test. Again, we have to define that before we even dive into strategy development. Well, what type of trader am I? Am I looking to trade every single day? Am I looking to trade multiple times in a day? Or am I looking to hold positions for days or weeks or even months? So those are some of the questions that you have to define before you develop a strategy, because there's a direct relationship between the time frame you use, the type of strategy you use, and the number of trades that are generated. So think about that. 165 trades, if you think about the time span of 10 years, this is about 16 trades per year. It may not be a lot. It's not a lot. It trades about once or twice a month. And we're going to take a look at some specifics, statistics on how frequently the strategy trades in just a moment. Let's go ahead and take a look at the next definition, which is the average trade net profit. Is the average amount of money, you won or lost for all completed trades during the specified period. Okay, so it's the total net profit divided by total number of trades. I know that number, it's pretty simple to calculate. Our average trade net profit, as you can see here in my report, I'm not sure if the font here is the right size. I think it's going to be very legible on your side. But if it is, let me know here in the chat and I'll increase the font size a tad bit, but I think it's comfortable for everyone. So the average trade net profit right now, it's $73.30. For the winners, it's $4.88. And for the losers, it's $2.56. Now, where do we get these numbers from? These numbers come from the total net profit. Now, if I go over here to my performance summary, let me pull up my calculator. My calculator here on the right-hand side. The total net profit on the strategy backtest is 12,094. So if I put that number into my calculator, 12,094, and I divide this number by the total number of trades, which is 165, divided by 165, that's going to give me a straight average of $73.29. If I go to the trade analysis, that is exactly the value that is here, $73.30. That's my average for all trades. Now, if you want to separate it between winners and losers, of course, you have a total gross winning, and then you have a total gross losing that gets divided in the same way. Those numbers are again on the performance summary. You have a gross profit of $35,000, and then you have a gross loss of $23,000. And what you do is you take, for example, the positive number, the 35,600, and divide it by the number of winning trades. How many winning trades do we have? Well, we go to the trade analysis, and we have 73 winners. Some of the information that you find here in the strategy performance report is going to overlap, because this statistics of number of winners and losers, I think it's also available in the performance summary. Here we have, winning trades and losing trades. You find it right here. See? It further breaks that number into long trades and short trades that you can see here on this report. And you can clearly see how the short trades have not done well on this strategy backtest. Now, again, this is not a class about refining the strategy or developing a strategy. It's just a class about learning to look at the numbers in the strategy performance report and make some sense out of them. Let's go here to the trade analysis tab one more time. And let's go over here and define the next set of metrics. We're going to see a calculation based on standard deviations. This is one standard deviation of average trade. Why is it important for us to look at standard deviations when we're looking at historical trade performance? The reason for it is because we want to be able to identify outliers. We want to be able to have a strategy backtest that is consistently giving you good results. If your strategy backtest, in this case, we have about $12,000 of net profit. If your $12,000 net profit was generated just by one or two trades mostly, then you know for a fact that you don't have a robust strategy backtest, because all the performance of your strategy relies on one or two trades. We already said that there's 165 unique trades into the strategy performance report in this particular one. So you want all the trades to have similar characteristics. You want to avoid those outliers. So the standard deviation calculation allows you to do certain measures and make sure that the trades are conforming to the mean or the average. So we're going to have several standard deviation calculation. It goes into detail as to what percentage of the trades that includes one standard deviation, which is the default value for the strategy performance report, is almost 70% of the trade, 68.2 if you want to be exact. Of course, if you modify the standard deviation calculation that the strategy performance report is using, the two standard deviations is 95%, three standard deviation is 99% of the population. So once you get to the 3 and 4, you're pretty much including those outliers trades. Let's talk about some of the metrics that we find in the strategy performance report to understand how we can utilize this. In line with the standard deviation calculation, we have these 3 metrics that we're going to take a look at right now. We have the average trade, which we already calculated. I think we've said it was $73, plus the 1 standard deviation. We have the average trade minus that standard deviation, and then you have a coefficient of variation. Let's go over here to the strategy performance report and define what those are with real numbers, right? So let's go here to my platform. All right, we have 1 standard deviation of average trade. Right now, I'm only looking at the all trades column because we can refine it into winners and losers, but that's something you can do afterwards. Once you understand what the main field is trying to tell you, then we'll have a better idea what the others are. But one standard deviation of average trade, it talks about variability. How far to either side does the average trade profit go? From the average trade, it can go up $591, or it can go down $591, because that's one standard deviation of an average trade. And in addition to giving you the variability of how much a trade can go up or down, it also gives you the exact mathematical formula. So it gives you from the average trade plus the one standard deviation of 591, that's 591 plus the $73 of the average trade gives you 664. And if you take that same average trade and you subtract the 591, it gives you a negative, let me put my glasses on, a negative 517. So looking at one standard deviation at 68% of the trades, they fall within this range, a positive 664 and a negative 517. Based on those two numbers, our average trade can vary 806%. Now that's your coefficient of variation. If we bring up the calculator one more time, okay, where's my calculator? There it is. And we say, okay, from 73.29696, that just rounds it up to 7330. But if we multiply this by that percentage, so it's 806.51, gives you that number. And when you divide that by 100, it gives you 591. You see, the 591 matches that number exactly. So it's a direct calculation of the variability in prices based on one standard deviation. Of course, you can increase the standard deviation, but this gives you some sort of an idea of the variability of your average trade. Because when you look at the average trade, it may seem like, oh, it's only $73. That's rather small. But we're talking about just a straight average. So looking at the variability also gives you, it just opens up your perception of what the profitability of the strategy can be. Not only the profitability, but also how much the strategy can go on the negative side as well. If you wanted to modify the standard deviations used in these calculations, just go here to this little button that says Customize Settings. I'm going to click there. And in the Settings tab, you can change the standard deviations. Notice what happens if I increase this number to 2. Now, based on the standard deviation percentages, this means that I'm increasing my population of analysis from 68% to 95%. I'm going to click OK and take a look at how these numbers change. Now we're not only talking about an 800% variability, we're talking about a 1600% variability. So our profits can go from a positive 1200 to a negative 1100. So it does include other trades that have maybe a bigger winning amount or a bigger losing amount, and is including that into the calculation. So what we want is the percentage here to be lower for the purpose of consistency. You don't want to have such a big variability that one time, you get a humongous winning trade, and then you all of a sudden you get a huge losing trade that makes you, it makes you break that balance in the strategy. All right, so that's standard deviations. Remember that you can control that here. Let's bring it down to 1, which is the default setting, but you can see that it has a direct impact in how much data or how many trades are being calculated. All right, let's go ahead and take a look at time averages. Here we have the average time in trades. If I look at this, you can just hover over it just to get the full thing. Sometimes I wonder what it says because it has the ellipses at the very end. But for anything that doesn't show completely, you can just hover and it gives you what the complete number is. So average time in trades, 21 days, 10 hours, and 45 minutes. We go back to what we were talking about earlier at the beginning of the presentation, what type of trader are you? In this particular back test, you know that every single trade has an average of 21 days. Some trades may be longer and some trades may be shorter, but in average, you're going to stay in one single trade 21 days. Is that your trading style? Do you trade more frequently? So again, going back to what is it that I want my strategy to do? Now, of course, we have that measure for winning and losing trades. For the winning trades, it goes up to 32 days. And for the losing trades, it's a little bit shorter, only 12 days, okay? Now, when it says here, average time between trades, it's interesting because we have an NA, not available, because what happens? What type of strategy did we say that we were going to test? We tested a MACD strategy, but we don't have any exits per se. What we're allowing the strategy to do is flip you back and forth between a long trade and a short trade. So when it tries to calculate the time between trades, there's no time between trades. You're pretty much always in the market. If I were to include a stop loss in here, then I would have a metric here that measures how long am I in the market without any trades. Let me push this here to the right. Let me go here to studies and add strategies. Let's say that I want to do a regular stop loss, let's say. And let's see, for my average trade, average loss 256. Let's go ahead and do a stop loss of $100. All right, so we have a stop in place. Now take a look at the average time between trades. Now the average is 17 days, 8 hours and 43 minutes. Now we have a metric because we introduce a stop loss. So at any given moment, your trade is going to be stopped and then it has to enter again to get you into a position. So there's a time where you're going to be flat. So that's something I wanted to do just to show you how you can get a number in there. Let me go ahead and edit the strategies. I'm going to remove the stop loss. Okay, so we're back to NA for time between trades because there isn't any. And average time between trade profit peaks. This is a very interesting calculation because it says 295 days. Now, that's something that I should have checked. I'm not sure if it's 295 calendar days. Pretty sure it's calendar days, not only counting trading days, but it says that the time that it takes you to make a new profit peak is 295 days. That's a long time waiting to reach a new peak. That's pretty impressive. How do we calculate that? Well, this is very connected to an equity curve line. So if I come over here to my performance graphs, just a moment so you can see my equity curve line. This is my graph right here. Let me make it bigger horizontally. There we go. The peaks that my report is talking about is those green dots that you see on this line, which is my equity curve line. Anytime or every time that makes a new peak, meaning that it's higher than what it was before, is going to put in a new green dots. That's what it's doing, just plotting a green dot every time it reaches a new peak. Now, what it does, it just takes all the time between those peaks and averages them together. So in average, it takes us about 295 days to reach that new peak. For a trader, that may be a little bit frustrating because I'm sitting here, wanting to increase my capital and not have to wait, 295 days for me to reach a new equity peak, saying that, oh, now I'm a little bit higher than what I was, almost a year ago. Some of the things that I look at a strategy and say, is this a strategy worth, trading? Now, because a lot of times, you look at the end result and you say, well, the end result says that I'm profitable. The end result says that I'm net, $12,000, whatever the net profit is. But sometimes we fail to look at what's happening in between. What does the strategy make us go through? What type of pain, what type of anxiety, and what type of emotions Will I go through, well, the strategy is trading, because that's where the that's where the that's where the success of strategy trader actually lies. You know, the possibility of you sticking with your strategy rules and being disciplined enough to realize that sometimes the strategy is not going to perform well and you're going to still stick to it. So there's got to be a full understanding on everything that happens throughout the strategy life so that you have true expectations. In here, our equity curve line, or equity peaks at least, takes about an average of 295 days to realize. Let's go here to the trade analysis again. That number is right here. Average time between trade profit peaks, something to look at. You know, some of those profit peaks may be closer to each other, and that's exciting because who doesn't like to increase their equity? But sometimes you're going to have to sit there for a long time to wait for that. Okay. Outliers. Outliers is a great number to look at. In our strategy backtest, it identified 3 of them. An average of those 3 trades, or the net, not the average, the net, $415. Those 415 is just the difference between my positive and my negative. But on the positive side, it says we had one outlier made $2,718. Why is that an outlier? An outlier just means that it doesn't conform to the average. Our average winning trade, remember, our average winning trade, where is it? Average winning trade is 488, right here. If you take all the winning trades, the average is 488. Over here, we have a trade that reached 2,718. So it's gonna label that trade as an outlier. You know, that's not natural. It's out of the ordinary. The same happens here on the negative side. You know, the average negative trade is $256, but here we have a trade that lost 3,133. Yeah, it's labeling that we had 2 of those, by the way. And here we have the loss of those 2 trades. 3,133. It's a big loss, but it doesn't conform to the average. So that's why it's labeled them as outliers. When we do the calculation on the standard deviations, the variability of our net profit, these outliers are not included because they are extreme trades. They do not conform to 68% of the population of trades. Something to think about, you know? If you wanted to have a little bit more information about these trades, just keep on looking down below in this section for run up and drawdown. If you don't know what run up and drawdown is, just go to the PDF that I shared with everyone. So these are some of the things that we didn't read because I mean the definition is kind of obvious. You know, average time in trades, between trades, and between trade profit peaks. Here it's a definition of outliers. And here is the definition of run up and drawdown. So maximum value displays the maximum profit or loss that occurred across all the trades. So if I could look over here to my strategy performance report, and I look at the section of run up and drawdown, you have 2 separate columns, one for run up and one for drawdown. The maximum value on the run up was 3,625, and the maximum drawdown was 1,763. You know, just to give you a very simple definition of run up and drawdown, that's just the maximum any trade was losing or winning at any specific time, but not realized, meaning that you didn't capture those profits. You didn't make that loss because you just waited it out. And a lot of times you are in a trade and you reach a maximum profit, and then you may get greedy and say, I'm just going to wait a little bit more so it wins more, and it doesn't win anymore. But that maximum profit that you could have achieved, that's your run up. You know, at a certain point, you're going to get out of the trade and you're going to realize your profits, and that's your closed P&L. But run up and drawdown is just the maximum that you could have achieved on the winning side and the losing side. Drawdown is something that we all need to be aware of, because drawdown is the maximum the strategy could have lost at any given moment. We're not saying that it lost that amount, but it is risk. It is measured in risk terms. Am I going to risk, $1,700 of drawdown to make an average of $73? Because that's our average net profit, $73. But look at the risk here. At one moment, we risked $1,763 just to make an average of 73. So those are things that we need to pay attention to and decide whether this drawdown goes in line with what the strategy is doing for me. Now, the dates are important because it allows you to go back in history and find out, well, what happened to the strategy that made me, have this drawdown and this run up. It's interesting that both times on the historical back test, both times for run up and drawdown happened in 2022, last year. Now, even though this historical back test goes back 10 years, you can see the date up here. It goes from 2013 to 2023. Both of these peaks happened last year, August 17th and June 13th. Let's go and look at the run up here of August 17th, 2022. Let me close my report for just a moment. August 17th, 2022. All right, so here we have November, December. All right, this is the beginning of 2023. I'm looking at August right here. Yep. So if we look at the report one more time, let's see the specific date. August 17th. August 17th is right here. See? It lines up, this bar lines up with this peak right here. So similar to the example that we were talking about, this long trade was entered in June 24th back here. And this huge uptrend. Apple just went up, 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 up. At this point, it reached the maximum peak, but you didn't exit there. You exited down here. You had the potential to exit up here because that's where it was, and you had an open trade, and that's what it's measuring. This maximum value of 3,625 is the profitability that you could have achieved, but you didn't. On this other side, we have June 13th, just right here. June 13th is this bar right here. Measures maximum drawdown. This is what happens on this trade. The market decided just to tank on a long position. We have a red line right here. And then the very low of this bar is our maximum drawdown. So we could have lost this amount. We didn't. We lost less than that, but not much more less than that, So it was a very big losing trade. But that's what run up and drawdown means. And we all need to be aware of that when we're measuring the performance of the strategy. William is asking, how do you create a strategy that combines two predefined strats? For example, MACD LE and Bollinger Bands LE need to be both true before entering a long trade. William, that's very possible. You can take, strategies in TradeStation and combine them. Now, it's not just as simple as putting them on the chart, because you can add the MACD and the Bollinger Bands into the chart, but they're still independent. What you're looking for the strategy to do is to only put on a trade when both the MACD and the Bollinger Bands are true. For that, you need a little bit of easy language tweaking. I'm not sure if you've been on one of my easy language classes, but that type of condition, that type of rule needs to be programmed in easy language so that the strategy looks at both the the Bollinger Bands and the MACD. The good thing about easy language is that both of the strategies are already written for you. And we just need to figure out how to combine, the two entry conditions, okay? Let's go back here to our report. We have the average value for that run up and drawdown. And then we have the similar one standard deviation calculation that we saw above and the variability on our drawdown. That's important too. Because I mean, of course, these are our maximum values, but then how does it deviate from the average? The average value is right here. There's a variability, one standard deviation, 723. And then it gives you the numbers here and how it varies. But then great measures, when we look at standard deviations, you want a strategy that is consistently giving you good results. And I think I said this earlier, and that's one of the reasons why we introduce, the standard deviation calculations, so that you're pretty much excluding the extremes. We talked about the outliers, and sometimes if we exclude those outliers, we have a report that's a little bit more consistent. Efficiency analysis. Let's go and talk a little bit about efficiency analysis. I know that we are running out of time, but I'll explain this briefly. Let's go over here to the PowerPoint. I think we have some definitions there on efficiency analysis. Efficiency analysis, as it says here, is the ability of the strategy to capture the maximum profit points from the actual trade entry and exit points. Okay, so it's important that we think about this. It looks at when the strategy entered and where it exited. Like, for example, let's go over here to a chart. On this particular trade, for example, that the strategy entered right here. This is the long trade. And it exited up here when it switched to a short trade. This is one single trade. So what it does, it just takes those two trades, the entry and the exit, and it looks at all the other prices within those two dates that would have given you a better entry or a better exit. And it calculates how far away those entry and exit points are. That is your percent or your entry or your trade efficiency when you've able to capture the best entry points of that trade. If we look at that entry right here, we know from looking at the data that that's not the best entry point. The best entry point would have been the low of this bar. I mean, I'm not saying that it was a bad trade, but it does give you the trade efficiency. How good is the strategy at capturing, those tops and those bottoms? So there's going to be a percentage from the price that it entered at and from the price that it could have entered at, and that's going to affect the trade efficiency. The exit efficiency is the exact same thing. Over here we have an exit, but we know that the most efficient exit would have been right here at the very top, where the maximum run-up was achieved. Remember that? That's would have been 100% efficiency. And that's exactly that's exactly how it's measured. If you're able to capture, the very bottom and the very top, then you have a trade efficiency of 100%. So when we look at those percentages here in my strategy performance report, let's go ahead and take a look. Data, strategy performance report. Average efficiency. Right here, we have a -10. When we have a negative number, it just means that it's actually counting against us. Now, let me try to understand what this average efficiency -10 actually means. Of course, we have the standard deviation. Averages sometimes are not a good indication of what the strategy is doing. When I look at this -10%, it just implies that I'm negatively efficient, which means that it should be losing money, but I'm not. And it's because the average doesn't take into account, the size of the other trades. It does, but it's just a simple average, and it may not be indicative of the total performance report. But here we have the entries and the exits. The average entry and exit, 50% efficiency, 34% efficiency. 55% efficiency is not bad. Very, very rarely the strategy is able to reach 100% efficiency. Of course, I clicked on something here. The same standard deviation calculations that you can look at. How much does it vary? The entry and the exit efficiency. So those are values that we can look at right here. And last, we have largest winners and losers, and what percentage of the total net profit that is. This is very important as well. If you have one winner or one loser that is a high percentage of the total net profit, then of course that's going to be an outlier. The series here down at the bottom of the trade analysis report provides you a view of how many times you're going to win or lose consecutively. Of course, I said you're going to. In this case, it's all historical back tests. So it doesn't measure or keep track of how many times you lose and win consecutively. Like the winning series and the losing series. The number on the left-hand side is the number of times or the number of trades that you lose or win consecutively. So if I'm looking at the winning series, I'm looking at the 5 here. That means 5 consecutive winning trades. How many times did that happen? 1 time. So the one or the numbers right here is the number of times that the series happened. Like for example, if I look at the 4, this is 4 consecutive winning trades. Sounds great, makes you happy because you're winning. That happened actually 2 times in the historical backtest where you had 4 consecutive winning trades. And the average gain per trade was $598. Pretty cool, huh? It also gives you, let me open this up so you can see what this number is. It also gives you what the average loss next trade was so that you don't get your expectations too high. It actually brings you down and says, okay, you've had, that number of consecutive winning trades, but here's your average loss on the next trade. Something to think about. But if you look at over here, the strategy was able to win 3 trades consecutively. That happened 7 times with an average win per series of $540. Now, I don't usually look at the winning trades because, that's fun and dandy. It's great for you to win consecutively. What I want to look at is the losing trades because that's what constitutes a psychological barrier to trading any strategy. Because how many times do you lose consecutively before you give up on any strategy idea? Notice over here we have 2 consecutive losing trades that happened 11 times in the historical backtest. Not bad, if you lose 2 times in a row, that's not such a bad streak. Although we have to look at the average loss per series, $376. But if you look at over here, like the row number 3 consecutive losing trades that happened 3 times in a 10-year span. And the average loss was 692. Now the average gain on the next trade was 957, which raises your hopes up a little bit. But these are things that you have to keep in mind in order to what is the feasibility of me trading a particular strategy and sticking to it. A lot of these factors play a big impact on the tradability of any strategy. All right. That's my presentation for today. I hope that you guys enjoy the PDF that I put together and that Manolo shared with everyone here. Make sure that you look at it and all the definitions that are there. There's a ton of different metrics here in the strategy performance report that you can take a look at if you're developing a strategy and measuring its profitability. Today, we only spoke about the trade analysis tab, but we're going to do a series of classes and maybe look at the performance summary. And one thing that I enjoy a lot is looking at the graphs. The performance graphs and the trade graphs are also an area that we need to take a look at, and dive deeper into the definition so that we can we have the tools available to measure the profitability of any strategy. Okay, check out our events schedule. We do master classes every single Tuesday, getting started classes on Wednesdays. If you have any questions, please join us in any class. Thank you for your time. Have a wonderful afternoon, and I hope that everyone can join me in a future class. Goodbye, everyone. Great having you.